Interest rates and inflation and recessions are all related. And during the Vietnam War, as the war progressed and went in a negative direction, inflation shot up to about 11%. Interest rates, they stayed pretty steady until inflation started to go up. And then we went into a recession in 74. And we were at about 10% inflation, just under 10%. But then we went into the 80s, all right, beginning of the 80s, big time recession. 79 to 82, inflation shot up. It shot up from 76 to a peak in 1980 of 13.5%. All right, and after that, the Fed took major drastic action, raised the Fed funds rate, all right, and then inflation dropped. By 83, inflation was back down to 3%. Inflation started going down during the recession, but interest rates still went up. By 1981, interest rates, 30-year mortgage rates, 16.6%. Can you imagine that? After we came out of the recession, interest rates went down, and they went down again pretty solid all the way through. We went through a recession. They steadied, and then went back down again coming out of that recession. So when we come out of recession, pretty obvious, interest rates go down. They go up going into the recession. They go down coming out of the recession. But it is the beginning of decades, we go into recession. All right, we went into recession. Inflation went up to 5.4% from 3 to 5.4%. Interest rates went down coming out of. They were steady going into the recession in 90. They went down. All right, and they continued to go down through the entire decade of the 90s. All right, they shot up a little bit in 2000. They got up to 8% in 2000, but that was because inflation started to go back up. All right, it went up to 3.38%. Then the Fed, basically, they raised the Fed funds rate and inflation came down. We had another recession, the dot-com boom, but interest rates coming out of that recession, they stayed down. 2008-2009 recession that we had, if you look at that, interest rates went down, Fed funds rate, inflation went down, all right? That 2008-2009 period, that recession was caused by the housing industry. And there were way more homes than there were buyers, all right? That caused the housing market to crash. We lowered the Fed funds rate went down to about zero, all right? And actually kind of like what happened at the beginning of our pandemic, all right? Fed funds rate went down to zero, all right? Interest rates went down, and they stayed down. But now inflation's peaking up. It's going up again. All right, inflation's going up, interest rates are going up. All right, and if you look at this graph, every time inflation's gone up, interest rates have gone up. All right, inflation starts to go down, interest rates still go up for a time frame. All right, there's no set time when interest rates will come back down, but they will come back down because there's a lot of different variables. But I show you this just so you see the impact of inflation, the impact of recessions on interest rates. All right, and again, I go back to what I said before. Typically, during a recession, housing prices are stable and actually increase. Okay, with the exception of 2008-2009 when the housing market caused a recession. All right, so you got to be patient. All right, and no, it's kind of like the stock market. Trying to time the stock market, it's pretty tough. But if you look at the stock market over the course of time, guess what? Despite the dips and the valleys, it goes up. All right, and you just got to stay in the game. Don't give up, all right, because then you're going to miss out. All right, that's about all I got for you. Take a look at the chart. Any questions, please don't hesitate to reach out. All right, have a great day. Aloha.